So, last class we did kind of a broad introduction to macro issues that hopefully reminded you of some of the stuff you may have learned in your principles class and gave you an idea of kind of the models and also the important institutions when it comes to kind of macroeconomic policy. This class, we're going to focus more specifically just on business cycles. So that is just the fluctuations in output and employment that occur over time in capitalist economies. I'm going to start with some background, so kind of why economists started looking at business cycles, followed by introducing what business cycles are kind of definitionally. Then we're going to talk about why recessions are so hard and maybe impossible to predict. And then I'm going to close with just a brief retelling of the events of the 2008 recession, because I feel like that's an important story for anybody with an economics degree to know. So, why do we care about business cycles? Business cycles are as old as capitalism itself. They were for a very long time taken to be this inevitable and natural part of the system, that this was kind of the price that we paid for economic development, was to deal with this kind of uneven activity over time. So we didn't really start measuring business cycles until around the Great Depression. In the U.S., it became apparent that the economy wasn't going to right itself all on its own, and that there needed to be some sort of government intervention to spur growth again. And so there came to be a lot more desire to measure the macroeconomy in various ways, GDP, unemployment, things that we've kind of talked about in the past, to see if the various interventions that were being undertaken were working. And then kind of parallel with this kind of practical, trying to solve things as you go approach in the U.S., there was Keynes's contributions with the general theory that really gave theoretical backing to government intervention in the macroeconomy. And with Keynes's contribution, it became that business cycles weren't taken to be this inevitable and natural part of capitalist development, but they could maybe be managed or even eliminated, being the kind of ultimate promise. This ultimate promise really was never fulfilled, but macro management has clearly been effective in reducing the volatility of business cycles since the Second World War. So, what are business cycles? So, they're alternating periods of economic expansion and contraction in GDP. So, we're talking about growth here. They're typically not going to be predictable, but they do have certain regular qualities about them. Some of those being that expansions are typically longer than recessions, and that on the long term, the kind of long-term growth path of GDP is upward sloping. So we are growing over time. There are a lot of variables that are closely related. So the definition of business cycles is talking about GDP growth, right? But this is also related to many other economic variables of interest. Unemployment is important and is, related to economic growth cycles, as are production amounts, so industrial production, non-industrial production. All those numbers are going to be related to the kind of definition of the business cycle, as well as incomes. And so these are all variables of interest to the macroeconomist. How do we identify recessions and expansions? Well, the beginning and end dates are based on the peaks and troughs of the cycle. In the past, a recession was just declared when there were 3 consecutive months of negative GDP growth. Basically, if there were 3 months where the economy was shrinking, then that was when a recession began. So by that definition, you don't really know you're in a recession until you're already 3 months in it. Today, a more complex procedure is used that looks at a bunch of different variables, but it's still a backward-looking process, so we still don't know we're in a recession until we're already in one. Recessions are generally going to be driven by the supply side or the demand side. If they're driven by aggregate demand, we can use this equation and kind of think about it. There should not be a t in that equation. It should be c plus I plus g plus in x. So the t shouldn't be there. But aggregate demand is equal to consumption plus investment plus government spending plus net exports. And this is all going to be affected by many factors, Through C&I, it's going to be through consumer and business confidence. G is government policy, and NX is going to be shaped by consumption decisions of people in the home country as well as the purchasing decisions of people abroad. So all of these things kind of affect aggregate demand and can be kind of a seed from where recession begins. Recessions may also be driven by external supply shocks, most famously in the 1970s with stagflation that was caused by an oil supply shock that caused increased prices across the economy and also slowed down economic activity. And so the famous stagflation, where we had high unemployment and high inflation all at the same time. So let's dig into why recessions are so hard to predict. Recessions are caused by two types of random events. Each of these types could originate from various different places in the economy, but broadly speaking, recessions are caused by supply shocks and demand shocks. And the business cycle is a summation of all events that are occurring, be they supply side events or demand side events. And each of these events also propagate through time. So, for instance, if there's a supply side shock in 1 year, that's going to have some effect on the economy in the next year through this kind of like summative effect. But the effect of past shocks decays over time. So policy, as we talked about last class, policy seemed to be doing a pretty good job at dealing with supply shocks before the Great Recession. There were kind of two main approaches. The real business cycle aligned with the classical perspective, where the driver of business cycles is external. It's random technology or total factor productivity shocks on the supply side. These could be introduced by government intervention, but also could just be completely random exogenous events. People behave rationally. There's no involuntary unemployment. The new Keynesian economics, which kind of aligned with the Keynesians that I mentioned previously, they admit that there are total factor productivity shocks, but there are also market imperfections that cause sticky prices and wages. And so these nominal price effects also can drive business cycles or make the intensity of a total factor productivity shock more or less large. So most business cycles in the new Keynesian side are driven by demand shocks. Most business cycles in the RBC or classical side are driven by supply side shocks. And so these are the two approaches. But both happen in reality, right? There are both supply shocks and demand shocks. And so in the moment, it's incredibly difficult to say what sort of shock is being experienced by simply looking at the data. Because just like any market, a full macroeconomy, we only observe price levels and quantities. We cannot observe supply and demand curves, or in this case, aggregate demand and aggregate supply curves directly. We can only see the equilibrium point as it fluctuates about. And supply shocks in interconnected sectors can also create their own demand effects. So, for instance, finance and petroleum touch so many other parts of the economy that if there's a supply shock there, it affects incomes for so many people that there's also a corresponding demand effect. So an individual event may have both supply and demand side implications. And so it makes it very difficult to suss out what we're looking at in the moment. As mentioned previously, both of these assume like a fixed system and efficient equilibrium that reacts to these external shocks. These are essentially exogenous theories of business cycles. Everything kind of results from external shocks. An endogenous theory argues that business cycles are a consequence of the system itself. So like like Marx and Schumpeter I presented last class. I would also like to add to that list Minsky. Minsky's theory really deals exclusively with the financial sector. And so for Minsky, stability encourages risk-taking because you're not likely to realize the downsides of that risk-taking in a stable condition. But whenever those risks are finally realized as losses, that leads to a period of instability. This pushes markets participants into safer investments, which restore stability. But we're right back at the beginning of the cycle here, where we've restored stability, which will encourage further risk taking. And so in this way, each period of instability lays the foundation for the next cycle. And so this is Minsky's idea that's based in finance. I'm not going to go through the whole Marxian story of technology and competition again, but I do want to augment the Marxian story by saying that a very similar story based in Marxian theory can be told using workers' bargaining power and employment being the driving force pushing profits down. So essentially, if the economy is running near potential output, many workers are going to be employed. That gives them bargaining power in wage negotiations, be that individually or unionized. And that increased bargaining power drives profits down as workers gain a larger and larger wage share, which then can lead to a profitability crisis as well. So that's just an alternative formulation of the Marxian cycle that's based on profit crisis. Schumpeter, in more detail, had this idea of various cycles that occur at differing frequencies. So there's the kitchen cycle, and this one is about a 4-year cycle. These are all approximate periods, but a 4-year cycle where inventory and time lags in the information gathering of commercial firms leads to over or under production. And so this is kind of the least intense and the shortest frequency cycle. Then there's the Hjulgar cycle, which is based in fixed investment and not just utilization. So in one sense, you can think about the kitchen cycle being based in variable costs, the Hjulgar cycle being based in fixed costs, which are not fixed in these longer periods. And so this generates another cycle. And finally, there's the 50-year-ish Kondratiev K cycles. So these 50-year cycles are based in technological change and the bunching of innovations. So there's kind of more technological progress occurs in highly developed countries, which leads to certain industries being exported to more peripheral countries that are less developed. And in this schema, the idea is that all 3 of these cycles lined up in their troughs to cause major negative events in the business cycle, like the Great Depression or maybe the 2008 recession. So that's all kind of like another set of endogenous theories of business cycles, where it's not just some external shock, total fracture productivity shock, or some like randomly distributed demand shocks that generate the cycle. So, going to wrap this up with just a kind of discussion of the 2008 recession. So the 2008 recession was the longest since the Second World War. This graph here shows the unemployment rate, the civilian unemployment rate in the U.S., and it spans late 2007 into 2008. And you can see it just kind of shoots up month after month after month, all the way into 2009. I believe this is actually by the quarter. And that we don't actually start having a declining unemployment rate until almost into 2010. So unemployment rose from 5% to 10%, doubling. An important part of this whole story was the housing sector, and housing prices fell by over 30%. And the S&P 500, just one of the many stock indices, lost over half its value over the course of the recession. There are a bunch of different stories you can tell about every major recession, but the kind of most salient for the 2008 recession is based in the housing bubble and the credit bubble associated with it. So there was a bubble in the housing market. A large number of risky mortgages were made. These were called the subprime loans. And these appeared less risky to banks at the time. So we'll talk about why they were perceived to be less risky here in just a moment. But the idea was that these loans were pretty safe, so banks did a whole bunch of them. And a related part of this is that this was also in a period where housing prices were just precipitously rising. They just continued to go up and up. And because of that, a bank making a loan on a house actually wasn't all that worried about the person they were making the loan to not making payments. Because, well, if they didn't make their payments, they could just take the house, which, oh look, is worth more than when we wrote the loan on it, right? The U.S. government also had a number of policies in place that helped fuel this housing bubble. Basically, U.S. government heavily subsidizes mortgage lending, even still to this day. And there was also a high degree of optimism among individuals and among institutions that inflated the bubble, be these banks, other mortgage lenders, and individuals just purchasing houses. And so the U.S. government's subsidization of housing, of mortgage-based housing, so people buying homes, is kind of part of this long-standing tradition in U.S. government policy that considers home ownership a good pursuit for society in and of itself. This is kind of a similar argument that is made for the mortgage interest housing deduction, that sort of thing. So, one of the reasons why these subprime loans seemed less risky to banks is that they basically could just sell them. So, the moment that the bank makes the loan, they can sell it to someone else who bundles it up with a whole bunch of other mortgage-backed securities and with a whole bunch of other housing loans to make mortgage-backed securities. And then that's the income stream of that is sold off to other people. Derivatives, which are a form of insurance, were thought of a way to even further mitigate this risk. And we'll go into more detail on all of this next class when we dig into finance. But essentially, this web of derivatives and derivatives on derivatives were established, each derivative having some financial value. And so more and more financial value is kind of piled up on this rickety foundation of bad mortgages. So when people finally started defaulting on all these mortgages, the issuers of derivatives, which were mostly insurance companies, had to pay out all of this insurance on people defaulting on their mortgages to the holders of mortgage-backed securities. And so this is why the insurance companies were among the first firms that needed bailouts, AIG being kind of the emblematic example there. And it quickly became clear that these insurance companies just didn't have the cash on hand to pay out all of their policyholders that were due payment, because nobody expected the entire U.S. housing market to tank all at the same time. They didn't expect people all across the country to be defaulting on their mortgages all at the same time. So the holders of derivatives, so the people that would be paid and that were due payment from these insurance companies, also were imperiled. And these entities were places like investment banks and hedge funds. And so those were the next sorts of institutions to begin to fall. But other banks, consumer or commercial banks, were also holding these assets, and they became imperiled as well. Banks needed all the liquidity they could get. They didn't want to appear to be unsafe in the middle of this crisis, so they needed to hold on to all the money they could get. And so even though the Fed was pumping more and more money into banks, they were extremely hesitant to trust anyone applying for a home loan. And so credit became very, very tight, demand for housing fell, and this caused housing prices to decline. Demand falls, price falls, right? And so as we all probably know, in the U.S., the vast majority of household wealth is held in the value of homes. And so this fall in housing prices eradicated a fifth of all wealth held by Americans. In response to all of this, fiscal and monetary stimulus were pursued, including something called quantitative easing, where the Fed just straight up started buying things. The Fed lowered the policy rate, the rate at which banks can borrow from the Fed, to near zero, and they also committed to keep it there for a very long time. The Fed and Treasury both bought up a huge amount of assets, mostly mortgage-backed securities. The TARP program was $450 billion in purchases alone. That was carried out by the Treasury. The Fed purchased even more assets. And despite all of this intervention, the recovery was quite slow. The Fed pumped a lot of money into the financial system, but everyone was too scared to lend any of it out, which led to a very slow recovery that I think we're all kind of familiar with. But this event was not isolated to the U.S. Europe certainly had its own problems, but the U.S. panic quickly spread to there and revealed many underlying issues. Many countries in the European Union had large balance of payments deficits, and typically whenever a country has a large balance of payments deficit, they can simply devalue their currency, which makes their exports more competitive in international markets. They can sell more and the economy can recover. But because these countries were part of the Eurozone, they lacked that option. They couldn't simply print more money to pay their obligations and also make their exports more competitive. And so rather than monetary stimulus, austerity was heavily pursued in the European Union. Concerns over deficits were paramount as it became clear that countries like Portugal, Spain, Italy, and Greece were far more indebted than they appeared to be initially. And so in this way, kind of European Union monetary policy made stimulus that would have come impossible because austerity was pursued instead. So rather than expanding government spending and the money supply whenever they most needed it, they instead provided a few bailout loans but largely clamped down. All right. So, wrapping things up, business cycles were once considered inevitable but now are actively managed. Most economists understand business cycles as the result of external shocks, yet others see them as like these intrinsic parts of the system and part of capitalism itself. Central banks and governments were really unprepared for the 2008 recession, just as we talked about last week, and the 2008 recession really has its roots in the interaction of the housing and financial sectors. And lastly, in a globalized world, recessions can easily spread from one nation to another, and not having control over your own monetary policy can make things far more difficult to deal with. All right, I think that's all I got for this class. We'll pick up next with finance.